this presentation started, I did just want to thank everyone for logging on and spending some time with us today. My name is Mychelle Holloway. Some of the names logging on I'm familiar with, and I'm probably your ESOP record keeper. Karen is also an ESOP record keeper here for SCS Advisors. And what we're going to do today is sort of a mishmash of all kinds of administrative.
The conference has been muted.
Consider at this time of year, the end of the year. Quite a few of these things are regardless of whether or not your plan is a calendar year end or a non-calendar year end. But a lot of these things are also, if you're a calendar year end plan. So if your plan year end is not 12/31, then some of these things you may be able to do at other times of the year. But certainly you want to make sure that at some point in time you are actually considering some of these issues that we're going to go over starting today. So the first one that we're going to talk about, let's see if we can get the slides to move here. This is a list of all the topics that we're going to go over today. And as I said, we're really going to hop around quite a bit. So if you have questions, I think you all have the chat box right here on this conference that you can actually type in questions to us. And if you think of something after this conference is over, then certainly you can get up with Karen and I, either one. Our information is on the last slide as far as how to contact us, as well as scsadvisors.com has a website that has everyone's contact information. So certainly take advantage of Karen and I, and if there are any questions, follow-up questions, or even if we run out of time and don't get to all these topics, definitely just give us a holler, and we will certainly be glad to help you out. The first topic that I was going to talk about was just compiling year-end employee information. Most ESOP plans, it seems, are calendar year plans. Certainly if you're an S-Corp, you're more than likely to be a calendar year plan. So this is the time of year where you kind of start thinking about, okay, what am I going to need to send to my record keeper once December 31st has passed. And, sort of get with your payroll providers and make sure they're ready to put the data together that you need. And you're also probably going to have to check with your 401k providers or any sort of other plan providers that you might have and make sure that they're ready to put together some data for you as well. A lot of the information that we ask for is very standard. But some of the information can be forgotten or more complicated than what you would think it would be. Certainly a big one is rehires. I think that you should never rehire because it's just a very complicated process when someone comes back to work. But these things happen. So there's definitely always going to be rehires. And the main thing for us is that you identify that they are rehires. And we're going to ask for, complete rehire history, dates of hire, dates of term. Sometimes we even, need to know hours worked in those different periods of time. So just bear with us. All of our questions do have a reason, but definitely, indicate who is a rehire. Status. You would think that would be, active or terminated. It should be simple, but unfortunately, people leave for different reasons, and sometimes it really makes an impact on allocations and eligibility, vesting, all kinds of different things. So when you have someone that's terminated, if it's not just a regular run-of-the-mill termination, please let us know. Retired, we can figure that out, so that's not necessarily a huge one, but definitely if they're disabled, deceased, if they're on a leave of absence, military leave is a big one, and we're going to talk about that in another slide. But those sorts of different reasons for leaving employment can result in different things, including hours. Sometimes you have to credit hours, people on Family Medical Leave Act or maternity leave or things like that. So let us know if it's not just a run-of-the-mill, they just left or we just fired them type of termination. You certainly want to let your record keeper know. Compensation, that can be as simple as gross wages. For a lot of plans it is, but you want to make sure that your document doesn't require you to report another form of compensation, because some documents have the allocations based on a very specific definition of compensation, and it may not be gross wages. So you want to make sure you're getting the right information to your record keepers. And as I said before, you're going to need to check with your other plan providers. Typically it's a 401k provider, but we need to know about other plan contributions. And one of the things to make sure you don't forget is reallocated forfeitures in that other plan. Sometimes that information does not get sent to whoever is doing the combined testing. So if you have more than one plan and you have forfeitures that are being reallocated, make sure that whoever is testing the combination of your plans gets that information. And again, whoever's testing the combination of plans for top-heavy needs to have the account balances from the other plan. S-Corps, you have additional things to think about, and we're actually going to talk about that in a little more detail on a slide coming up. And as promised, military rehires, and I'm not going to read to you, but there's 2 acts out there that basically regulate how we have to treat military rehires. And basically, if someone leaves your company because they've gone to serve our country, you don't want them to not benefit because they weren't in your employment, they were serving our country. So that's the rationale behind both of these acts, is just to give them every advantage that you can. So if someone leaves your employment and comes back to your company and is rehired after honorable discharge, then you're going to have to make up some vesting and make up contributions. So you want to make sure that you let your record keeper know that someone's on military leave and they're not just a run-of-the-mill rehire, they're a special rehire. On a sad note, if someone passes away or dies while serving our country, you're basically going to treat them as if they were rehired, and you'll make their vesting up and you'll make up their contributions, and that's so that their beneficiary can still get some benefit. So just keep both of those things in mind when you're putting together your census data. Disclosures, at this time of year, if you guys are a calendar year plan, or really whenever your entry dates are for your plan, you have 90 days after that date to provide an SPD, which is a summary plan description. So you might want to take a look at who's going to be entering your plan coming up. What a lot of my clients do and what I recommend, and unless you have confidential information in your SPD, which I don't know that anyone does, just hand that out when someone becomes a full-time employee. So while you're doing the normal employment process, just go ahead and hand out the SPD at that time, and then you're not really having to keep track of when people enter, especially if you have a retro entry date. So you may not know until like now that someone got 1,000 hours in 2012, and so yes, they entered the plan back in January of 2012. So if you have a retro entry date for your plan, I would suggest just hand out that SPD when someone joins your workforce. Beneficiary forms, this is a good time of year to go through your files, make sure you have beneficiary forms for everyone, make sure they look pretty current, they're not 10 years old. And if you don't have them, you can go ahead and just send them out. SAR, if you were a calendar year plan and you were on extension for your 5,500, those have to be circulated by December 15th. I think almost all of my clients just hand those out when they hand out the statements, which is also a good practice, and then you don't have to worry about another deadline. Okay, as promised, if you're an S-Corp, you always have 409P testing on your mind. If you have disqualified persons, or if you are close to having disqualified persons, then you might want to run what I call a pre-test on your 409P, and that's sort of like your best guess as to if you're going to be in good shape for the plan year end that's getting ready to happen. The most important thing I think to remember about 409P is you can't correct it. With a lot of compliance testing, you run the test, you fail, okay, no big deal, you correct it, you go on with life. 409P, there is no correction. As soon as you fail, wham, you are exposed to penalties and taxes and all sorts of consequences. But you can prevent the failure. So what you want to have happen is you want to know if there's going to be any issues before your plan year end crosses. ESOPs are only allocated once a year, so we rely on that, once a year allocation date to sort of give us a little bit of room with 409P to kind of test and make sure you're going to be okay. So if you're an SES client, then each plan year end, you're getting a 409P data request. And basically, think about the information that you report on that. And if it's going to be different than what you reported to us last year, let your record keeper know they're probably going to want to take some extra steps, run that pretest, and make sure that the changes are not going to adversely affect the results of the 409P test. Things that you're looking for are changes in synthetic equity, changes in family relationships and like maybe who you hired. If you have an outside owner that has a lot of shares of stock and you hire, their kids and their brother and their sister, things like that, you might want to let us know. If your workforce significantly changed, if you used to have, 300 participants and now you have 150, obviously that's going to impact who's getting the allocations for this year. Instead of it going, instead of that pie being spread out over 300 people, it's going to be spread out over 150 people. So if it's the same shaped pie, you're going to have people getting a lot higher allocations. Obviously, if your outside ownership has changed, people have bought and sold shares outside the ESOP, that could be a huge deal. So anything that would go on that 409P request that you get from us that it's changed, don't wait until the year end to send that. Go ahead and let us know so that we can run that pretest for you. See what's next. Okay, year-end reporting. Now, these are things that you're doing right now regardless of when your ESOP plan year-end is, because all these things are based on the calendar year no matter what. Form 1099-Rs, if you made a distribution from your ESOP during the 2012 year, you're going to need to send out a 1099-R, even if they rolled it over. The only distribution that doesn't need a 1099-R is if it's $10 or less, which doesn't happen very often. So for the most part, even if they rolled it over, they will still get a 1099-R. And those, of course, are due to the participant by January 31st. So you can go ahead now and start putting together, a spreadsheet, with all your information, your addresses and Social Security numbers, and you may already have that from where you process the distribution. If you are a C Corp and you do dividends to your participants, those forms are also due. The Form 945, that is what reconciles the federal taxes that you withheld from your distributions throughout the year. So again, you want to make sure you get all that information together, whether you're doing it in-house or you have a trustee that does the information for you, or if you hire SES to do those forms for you, you will need to get all that information in an organized fashion. One note on the dividends, if you're a C Corp and you pay out dividends, take a moment to make sure you're using the right form. If you pay the dividends out to participants straight from the company actually issues those checks, that's a 1099 dividend. But if the company just gives the lump sum amount to the ESOP trust and the ESOP actually issues the checks to participants, that's actually done on a 1099-R. That's considered a distribution from your ESOP, and there's a special code that goes in box 7 so that the IRS knows that it wasn't a regular benefit distribution, that it was a dividend. Another thing to be thinking about, and you could do this, now if you're a calendar year plan, or really at any time when you're, coming up on the end of a plan year end, you want to think about partial plan termination. SES will test your plan for this once you send in your census data. We will test to see if you had a partial plan termination during the year. And basically, what that test is, and again, I'm not going to read all this to you, I'll just talk, but what that test looks at is it looks at your participants, okay? So if someone is not in your plan, they're not on the test. And then it looks at your active participants, the ones that were actually worked at least an hour during that time period that you're testing, which most often is the 12-month plan year. If someone terminated, 5 years ago, they're not going to be in the test either. So then what it does is it looks at the turnover rate. So it looks at how many of those participants that, that were working during the year, how many of those terminated during the year. And so it's just a fraction, okay? The number of participants terminating during the year divided by total number of participants during the year. And if the turnover rate is greater than 20%, that's typically considered partial plan termination. Now, the burden of proof is on you as the company. If that's just your normal turnover rate, there are things that you can do to prove that you've not had a partial plan term. But basically 20% is the threshold. If you're under 20%, the burden of proof is on the IRS. So that's the threshold percentage that we're looking at. One thing that you can do is you can actually split your terminated participants according to whether or not they terminated voluntarily or what we call involuntarily. And the ones that terminated voluntarily, you don't have to count them against you. That would be someone who retired, someone who became disabled, someone who was deceased, or someone who left, on their own accord. They moved or they got a better offer, things like that. Now, you want to make sure if you're going to count them as voluntary and you're using that determination in order to, stay under that 20% threshold, you want to have records in your files where, maybe a letter from them resigning or something like that. Involuntarily termination is something the company did initiated that termination. Outright you fired them, you closed the plant, you cut their salary by a half. Something that the company did made them leave the workforce. And those, you have to count those when you're doing the partial plan termination. So what happens if you do have a partial termination? The people that were affected by that partial plan termination will be 100% vested. So you don't have to 100% vest everyone, but you do have to 100% vest the ones that terminated. Now, the gray area, and you would probably need to ask your legal counsel to see what their opinion was, you would definitely have to 100% vest the people that you consider involuntarily terminated. But what about the other people that termed during the year? That's kind of a gray area. So you would probably get your legal counsel to help you decide if you needed to vest 100% vest everyone that terminated during the plan year, or just those that you're considering involuntarily terminated. And I think that brings us to Karen's part of the show.
Yes, distributions, everybody's favorite. That's really all your participants are going to be interested in once they terminate, obviously, is when do I get my money? So we're going to kind of go through the basics of distributions just to give you an idea. It's a very tricky subject. So obviously you want to be well aware of what the terms are in your plan document or in your distribution policy. So timing, method, and form are basically the three basics. Timing for distributions depends basically on if it's a death, disability, regular termination, retirement. So there are general rules for death, disability, or retirement. Generally, they have to begin by the end of the following plan year. Other terminations, either you leave of your own accord or you're fired, whatever. Generally, by the end of the sixth plan year, following the year in which the participant or former participant terminates. You can make these distribution terms a little more generous if you wish. I guess it really just depends on what's in your trust and what you're hoping to accomplish. Methods of distribution, there's lump sum, there's installments. Again, it basically is going to depend on your trust and how you wish for your former participants to receive distributions. Installments usually are in substantially the same amount of money for over the number of installments. So it would basically be your balance from the prior year divided by the remaining number of payments in the plan, so they all pretty much equal out. There is an exception for large balances by the code, but normally we really don't run into that situation. Let's see. So some forms of distribution, obviously there are stock, cash, or a combination of both to be distributed. So a little bit tricky if you have a C Corp and your bylaws don't restrict ownership of shares, then your participants have the right to demand a distribution in the form of shares. S Corp, this is it's not an issue, but if you do have a C Corp, you want to make sure that your bylaws do restrict if you don't intend for your former participants to get a stock distribution. And then there are also mandatory distributions, which are basically RMDs for those who are over the age of 70 and a half. Again, we'll talk about this in a little more detail to cover these mandatory distributions. There's also QDROs, Qualified Domestic Relations Order. This, in the case of your participant, either a divorce decree or something where their account is separated and their former spouse or children are allowed a part of their account. So we basically want to look at here, we'll get a QDRO in, and you want to make sure that you review it and make sure that it agrees with the plan document terms. And then I'm not sure, the slide's kind of a little all over the place here with mandatory withholding on distributions that are eligible. I don't think this really all relates to QDROs, but there are special tax notices that we have to send out as well. So let's see. Okay, so safe harbor automatic rollovers. This is basically for distributions now that are under $5,000. You can roll them over without consent, but the fiduciary has to, there really has to be some sort of plan in place for these investments in order to sell the shares back to the ESOP, that they're in some sort of interest-bearing account with a reasonable rate of return. This so that former participants aren't sharing in any fair market value increase in the plan where you don't necessarily want to distribute to them right away, but you don't want them holding on to shares as fair market value increases or possibly decreases. So okay. So your document pretty much governs the timing, form, and your method of your distributions to all your former participants. And your document pretty much tells you by which date the distribution must start. Of course, you are eligible to delay on certain ESOP distributions if there's an outstanding loan, and it's written in your document that you may delay distributions until the loan is paid off. We also like to suggest that plans have a separate written distribution policy, separate from the plan document, which makes it a little bit easier if you want to change up your terms from year to year just to meet the needs of your ESOP, rather than having to amend the actual plan document when you want to make changes to your distribution policy. Okay, so next is repurchase obligations. Repurchase obligation, it's pretty much just a liability from what you have in the trust and what you owe to your participants as you make your distributions. So it's essential that you have a repurchase obligation projection in place so that you're going to know from year to year what you're going to face as far as requirements for payouts. And it basically says every share in your ESOP must be redeemed or converted to cash at some point in the future. So we want to account for that and make sure you know what you're going to be on the hook for to pay out from year to year. So you want to look at multiple scenarios and different financial variables when you're looking at your repurchase obligation. So some of the factors that would affect your repurchase, obviously your fair market value is going to be the biggest indication of what your repurchase obligation is going to be. If it's trending upward, then obviously you're going to have a larger obligation as time goes on. Your distribution policy also, whether or not you have a 5-year break or whether you're recycling is going to determine future years what your obligation is. Plan design, your eligibility, your vesting, your effective dates, all of these obviously play a role, your contributions, and even your demographics. Obviously if you have older participants with more longevity, that's definitely going to play a role as well. So your plan design and how it affects it, basically with your eligibility and your plan entry, the more people who get in, obviously more shares are going to be allocated, and the younger they are, the more shares they're going to have when they leave. I mean, that's just kind of common sense. Your vesting, whether or not you do a cliff vesting or a graded vesting makes a difference. Obviously a cliff, you're going to go from 0 to 100 in one fell swoop. Whereas, if you have a 6-year graded, there's a little bit more opportunity for those people to kind of stick around so that they get to that 100%. So, and then of course contributions, the more you put in, the more you're going to have to buy back. And then termination provisions, segregated accounts. If you decide you want to segregate your participants so they're not sharing in the fair market value increase, if you go ahead and segregate people, that means you're basically paying for their distribution before they actually get cash, because you'll have to put cash in the plan in order to segregate them. So that's basically saying, you're paying a distribution. It's just not going to your participant at that point. Diversification. That's an automatic when you elect to diversify. Your distribution provisions, obviously a lump sum means that you're going to have to put in right away. And actually this is good if your share value is rising, because it's going to save you money in the end. As opposed to if you're doing an installment, you're going to draw that out. And if your share value is rising, you're obviously going to be paying more. So a lot of you, I'm sure, have looked into a repurchase obligation study, which is a really great tool to help you kind of project what your long-term needs are going to be. So SES does offer to do repurchase studies, and there's also some other companies out there that specialize in it that do a really great job. But what you'll do is you'll basically send 3 or 4 prior years of data, your census data, so that we can kind of take a look at it and analyze it based on retirement, looking at date of birth, look at what the prior turnover rate was and what your diversification needs are. So it's a really nice tool to kind of project where you're going to be, 5 years or even 15, 20 years down the road. So, So the study basically will look at the share value and how it's trending, what it's done, and kind of project what it will do based on that in the future. And then your employee population, so your turnover rates and what your compensation is doing, how that's trending as well. So the more information you can provide, obviously the better your study will be. So, and then of course a couple different funding options which you would go over after your obligation study is done is how you want to fund for your repurchase, either a pay-as-you-go or maybe a sinking fund that's inside or outside of the ESOP. Okay, so RMDs and diversifications. RMDs are required minimum distributions that are due to anybody over the age of 70 and a half who has terminated the plan, or anyone over the age of 70 and a half who is a 5% owner in the plan. So the required beginning date, once this happens, would be April 1st of the following calendar year. So towards the end of the year, you definitely want to make sure you check and see your participants that are getting up there in age, whether or not they have termed in that year or whether they plan on terminating by the end of the plan year, because you'll need to be ready for your TPA to process those RMDs. Which is basically factored by using, there's a life expectancy factor that's out there that your TPA will calculate based on age and the amounts vested in your participant's account. Who's a 5% owner? This would be an owner of anyone with more than 5% ownership in the company. And is over the age of 70 and a half. So active, still a factor. We'd still need to pay them RMDs. Also, this is related group members that are treated as single employees. So, let's say Joe Smith is greater than 5% owner, then Joe, if his wife is in the plan, would be required as well. Basically attribution rules for 318. So. And then if a participant is a 5% owner during the calendar year, he's also considered a 5% owner going on, even if he no longer owns that 5%. So that's just an ongoing RMD for him. So RMDs are not eligible for rollover distributions. They must be paid in cash. Only the RMD amount. Now, obviously, the whole account balance would be eligible for rollover, but not the RMD portion. So, so you'll definitely want to ask your participants if they want to withhold more than the 20% withholding rate. It is allowable for them to withhold an additional amount. And diversification, just a quick note on that. Participants are supposed to receive notice and an election within the first 90 days at the end of the plan year, which they meet diversification eligibility. Diversification will be defined in your plan document. Typically, it's I'm sorry, Mychelle. I just realized I'm doing your RMD. I'm so sorry.
You did a great job.
I kind of jumped in on your part here. But anyway, so there's a 90-day window following the end of the year, and if for the most part, plans aren't going to know whether what the eligibility amount is, but we recommend just sending out a notice and kind of doing a best guess estimate for diversification issues. So, Mychelle, I don't know if you want to jump in here for. I'm so sorry. I started.
You did a great job on those age 70 and a half. Just a note on the diversification notices. The notices that get sent out within 90 days of the plan year end are pretty generic. They basically say, dear so-and-so, you're eligible, and we will get back to you once the share value and the allocation work is done. So, but it is good to send out the notices and sort of meet that 90-day deadline. And then, once your allocation work is done for the plan year, then you can actually send out the forms that have the detail, the number of shares and the value and the options that you're going to give them in order to satisfy diversification requirements. But for right now, I know as I'm going through my plans now, I'm looking to see, okay, who's qualifying as of December 31st, 2012, and who's going to need to be added to the notice list. I saw where we did get a question. Someone asked, are you required to send out the SAR if the plan has been closed and participants have been paid out subsequent to the 12/31/11 plan year end? The SAR is the summary annual report, and it's a brief summary of the information that was filed with your 5500. And it's required to be handed out to participants. So from this question, it seems like they have been paid out their entire account balance. So that means they're no longer a participant in the plan. If the plan has also been closed out, then there's probably would be all zeros anyway on the SAR. So no, you only have to hand out the SAR to someone that's still considered a participant in your plan. So if someone forfeits their account balance during the year or gets paid out a total distribution and has no remaining account balance, you don't have to send the SAR to them. I also have clients that don't send SARs or statements to participants that are terminated with zero vested benefit. They're just sort of waiting to forfeit their account balance because they're not considered participants on the 5500. So, and I think, Karen, I guess you're going to keep on going for us?
Sure, why not?
Okay.
All right, so our next section, we just have some kind of miscellaneous kind of don't forget and make sure we're current here. So just a few kind of bullet points for everything. You want to make sure that your ESOP document is current with all the required amendments. There was a PPA vesting requirement and a 2009 waiver. Mychelle, I don't think there's anything current this year that's a required amendment. Is there?
No, I think that 2009 RMD was the main one. The one
right,
amendment I guess that I am seeing is if you're trying to get your determination letter, I'm seeing amendments that the IRS has sort of requested that you get in order for them to issue that determination letter.
Okay. All right. You want to make sure, obviously, that your current SPD and your SMM. Mychelle talked a little bit about your SPDs before being provided to your new entrants, and then also with statements sometimes if you don't get or if you don't know that your new participants have gotten them, that's also a good trigger as well, along with your SAR to your participants with statements. Your IRS plan determination submission. Know your cycle for submission. I think now they're on 5-year cycles, and it's determined by the last digit of your EIN number. So you definitely want to check with your attorney or even your TPA to make sure that you're in the right cycle for your IRS submission. And then, of course, make sure your distribution policy, if you have a separate policy, that is current as well and kind of meets the needs for how you want your distributions to occur for that year. Design your plan carefully. If you're a new ESOP, then you want to make sure you ask questions about eligibility, timing, rehires. Know your plan document well. It's really important that it says that it matches your intent and that it says what you want it to say. Otherwise, it'll cost you some money and some amendments to make sure that it's stating what you want to happen in the plan. So, also make sure your attorneys that are drafting your ESOP know you have a 401k plan if you do, and that each is aware of the other. As Mychelle said earlier, testing is really important when you're combining plans. So, really important to know the differences between them and make sure that both TPAs are aware. So, whoever is working with your TPA over plan administration, again, make sure that you know what your provisions are. And if you don't know or if you're unsure, ask your TPA. Another thing is to read the summary plan description and make sure it matches the plan. I can't tell you, we've seen this where the plan document doesn't match a provision in the SPD. So you definitely want to make sure that everything in the SPD matches the plan. And if there is a difference, I believe that the plan document obviously supersedes SPD. So if you're just looking at the SPD in order to figure out what's going on in the plan, you definitely want to make sure they match. So, and then anticipate your employee questions. You know employees are going to call you regarding eligibility, obviously distributions. That's the first question that comes up. So make sure you know what's going on in your plan. Of course, your plan's only as good as the team behind you. So check out the people that you're working with, your valuation company, your TPA, your attorney, your lender, and make sure that everyone is on the same page. I get a lot of emails from clients that will copy everybody on the question just to make sure that nobody is missing something. So always a good idea to have everybody talking. And in this industry, chances are your attorney knows the TPA and knows the lender. So, you know, it's always a good idea to include everybody. Another thing that you might want to think about is vendor fees that you can pay for out of the ESOP. A lot of clients probably don't know this, that you can pay for your ESOP TPA fees or for your valuation. You can pay for those things out of the ESOP. You just want to make sure with your TPA before year-end that what you're trying to expense is allowable under the ESOP. So, and establish a timeline. This is always a great idea. End of the year, beginning of the year, get together with your TPAs and your evaluator and put together a timeline so that everyone can work together based on the other one's schedule. I mean, you've got to go through 3 or 4 different people before you can get your final administration done. So, it's important to put that together, and your TPA will help you if you need to, put a timeline together that works for you. Appropriate accounting. This is a big one because a lot of times ESOPs will kind of skip over the ESOP portion, especially when paying a contribution or a dividend, where they'll pay a contribution right out of the corporate account to pay on a note, but they won't run it through the ESOP. There's no paper trail. So it's kind of difficult as a TPA when you don't see anything going through the ESOP account, but yet there's loan payments to the note. So you want to make sure that everything kind of runs through the ESOP just so that nobody misses anything, basically. Dividends, you want to make sure if there's dividends paid that the ESOP receives its share of dividends. And understand your share release. This is really important when you have a note in the plan and shares are being released as payments are made on the note. There's a couple different types of share release. There's one based on principal and interest, one based on just principal payments. So you want to make sure you check your document, check the note, and make sure that it's specific in how it's to be repaid and how the shares are to be released. Expenses, again, we kind of talked about this. Reasonable expenses for the plan administration, if it's part of the company or if it's indeed part of the ESOP, and kind of think about who is it benefiting. If it's not really benefiting your ESOP participants, you might want to think twice about paying it through the ESOP. Understanding your contribution limits. You kind of want to work with your TPA before the deadline for filing to make sure that you actually are within your limits on contributions. So very important before you file your corporate tax returns that you make sure that what you're contributing, the amount that you're contributing, is allowable. And then also we need to figure out too if your contributions aren't meeting the ESOP debt service, where is that extra money going to come from? Just touching on the share release again, really important that the CPA and the TPA understand the differences when you're doing a share release and whether or not there's an internal loan, if there's a mirror loan. I mean, sometimes there's loans between the bank and the company, but then the ESOP to the company. So you want to make sure you understand what those differences are and that everyone agrees on how the shares are being released. Review your reports and ask questions. It's really important when we send you a draft report that you look things over and make sure that everything makes sense to you. And if it doesn't, to ask questions. What are annual additions, basically? If you don't understand how this report works or what it's telling you, then definitely, you need to ask questions so that we can explain how the testing works. Dividends being allocated. Dividends, of course, are allocated different than contributions would be in the plan. So if a participant has no beginning shares in the ESOP, they're not going to get any dividends because it's based on your beginning shares. So a little bit different than contributions. So a lot of questions, and it's really important that you kind of read things over and make sure you understand how everything is working. And then, of course, along with asking questions, ask for advice. That's what we're here for. That's what your CPA is there for. That's what your attorney is there for. Do you need an audit? What is my trustee responsible for? Do you have part-time employees? Can they be in the ESOP? All things that are covered, and a lot of it is covered through the plan document, which, true, it's 70 pages long, but it's a good idea to get really comfortable with it and, highlight it and ask questions and make sure you understand everything. And with that, Mychelle, you can, I guess, we'll wrap it up talking about locating missing participants.
Right. Okay, so the last thing that we wanted to talk about today is locating missing participants. Invariably, when you're sending out the statements or you're sending out distribution forms for the terminated participants, somebody comes back and the address is no longer valid, and there's just people that just go lost, which I can understand, for some of their smaller account balances, but some of these missing participants actually have, a pretty good chunk of change in their account. So, you really want to do all you can to try and find them. So there are some steps that the Department of Labor actually, strongly recommends that you take. One is to send the distribution paperwork using certified mail. That gives you proof that you have sent to the last known address, that you have tried to find this person. You should review your other plans that you have, whether it be health insurance, life insurance, disability, or 401k type of plans. They may have contacted one of those providers with a more recent address and just not thought about their ESOP money. So you definitely want to look at all the plans that you're sponsoring and see if anyone has any more current information on this person that you're trying to locate. Another thing that you should do is check the beneficiary forms. You can actually contact the beneficiaries that the lost participant had listed and see if they know if there is a more current forwarding address for that lost participant. One thing that you cannot do anymore is the letter forwarding service that was provided by the IRS. They have stopped doing that. It was actually a pretty good service. You would send to the IRS letters, and they would send those letters out to the address that they had on file, assuming that the IRS would have the most recent address for people. But they've stopped doing that now, so you can no longer do that stuff anymore. Some of the things that are optional search methods, the Internet has a whole host of tools that you can use to try to find people. There's commercial locator services and credit reporting agencies. One thing that I usually recommend is that you talk to people that are still at your company that were friends. or at least friendly with the person you're trying to find. Maybe they've kept in touch and at least have an email or Facebook connection or something like that with the person you're trying to find. You certainly want to make sure that if you're going to pay a fee to find someone, that it's logical for their account balance. You don't want to spend $100 trying to find someone that has $10 in their account. So you certainly want to make sure that's reasonable, and you can charge that fee to the person's account balance. So if someone has $5,000 and you spend $100 to find them, that's you can actually charge their account for that service. So you go through all these steps, and still you cannot locate this missing participant. At that point, you're in your document. You're looking at your plan document for guidance on what can we do with this account balance. We've done all the Department of Labor recommended steps, and we just cannot find this person. And then your document is going to allow for one of the following. There may be safe harbor language in there where you can actually automatically roll over to an IRA account balances that are $5,000 or less, even though you don't have the consent of that participant. Your document might allow you to roll it over to your 401k plan. To me, that makes little sense because then they're just lost in your 401k plan, but that is one of the options. Or your document might say, forfeit that account balance, reallocate it to other eligible participants. The caveat there is if that person comes back and makes a claim, you will have to reinstate their account balance. So you can go ahead and forfeit it and reallocate it, just knowing in the back of your mind if that missing person does make an appearance, you will have to reinstate their account balance and go ahead and pay them what they were due. So for that reason, I usually tell people to not do this forfeiture step until the person's been gone for, at least a year or two. You want to make sure that they don't, come to realize, oh, I've not gotten an ESOP statement, or I've not heard from that company in a while, and they don't contact you. And then you're having to go through the step of having to, reinstate their account. So make sure that they're really lost before you go to the forfeiture of the account balance. So that concludes our presentation today. And again, I just, would welcome any questions that you guys come up with afterwards. Definitely get up with either myself or Karen. And I just thank you all for your time. Karen, do you have any last words of wisdom?
No. Thanks, everyone, for joining us. And, like Mychelle said, just feel free to call us or email us if you have any questions. And we also have the slideshow available in PDF if anybody wants to get a copy of that as well.
Right, and I think it will also be on the SES website eventually. So if you wanted to have someone else in your company listen to it, it'll be posted out there. But with that, just thank everyone and happy Thanksgiving.
Thanks, everybody.
Premiumbeat.com